Tech has tanked, with the NASDAQ now down more than 10% so far this year. A big part of the concern, the global economic slowdown means companies are spending less on technology. That's why tech investors were so interested to hear from Cisco, which is seen as a barometer of corporate IT spending.
It generated $49 billion in revenue in its last fiscal year. So the bottom line is it was very big, it remains big, and its earnings report is important for folks that want an updated view as to how the global economy and technology spending are playing out for this kind of company.
We've already heard from two big tech names that said a challenging global economy and soft IT spending was impacting their business. IBM's CFO, Martin Schroeter, called the macro environment mixed, and Intel's CEO, Brian Krzanich, said macro weakness weighed on the chipmakers' results. The problem for many tech companies, though, is that global tech spending is expected to grow at only a moderate pace. Business and government purchases of tech goods and services will only grow about 2% this year, according to Forrester. Now, that's better than the 3% drop suffered last year, but still represents a modest pace of expansion. Analysts say a rising U.S. dollar and weaker economic growth in China and Europe will pressure spending in 2016. So where does that leave tech investors? There's a good chance that the bad news is already priced in. As S&P's Kessler notes, many of these stocks have already sold off, and as a result, S&P recommends investors buy Cisco, IBM, and Intel. For Nightly Business Report, I'm Josh Lipton in San Francisco.